So once again, good evening, everyone, and welcome to this webinar powered by Century Financial. And today we are going to talk about bond investing demystified. And the idea behind this session is going to be very simple. We are going to talk, first of all, starting from the very basic of what bonds actually are, and what are the sort of strategies which can be used, because the market is very volatile, and it's important to talk about bonds these days because this was not something which in last 10 years, in fact I should say pre-COVID, nobody was really interested in bonds. It has been there for the longest time. It's a very easiest way to invest for those investors who are very conservative, who do not want to take too much risk or who do not want to take too many chances. But since before COVID, the returns in bonds were not very impressive, and we are going to do some touch base on what has happened post COVID and why bonds all of a sudden have become the limelight of the investing world. And these are a few things which will give us also some idea about diversification, because a lot of us talk about stocks as an investment, a lot of us talks about commodities or investing in gold, but bonds is something which is equally important currently, given how the landscape of financial markets have changed in last 2 to 3 years. Just to make sure that the session doesn't become very boring and continues to be very interactive, you have a chat option just next to you on your screen, and you can use the chat option to ask any questions live while we are discussing about this. And if I'm able to answer it right away, I'll definitely do it. Or in case if you have in case I'm not able to answer those questions, I'll definitely reach you out after the session. So please use your chat options. If you can hear me properly, if you can see my presentation, please write a yes or a okay. That would help me understand that the network is pretty clear and you can hear my voice, you can see my presentation as well, and we can go as smooth in this session as we can. And as I said, please continue to ask any questions you have regarding financial markets, regarding your investments, and we'll try to touch base and try to make it much more interesting for you. So, starting with the fact, what is a bond? This is something which has been there for years and years, and we have seen that a lot of investors are actually confused about how bonds actually work. How much investment do you actually need to invest into a bond? And we are also going to discuss about a few strategies. I'll open up some flyers after the session ends, and we'll go through some strategies and try to understand how those work. So bond is like a loan, basically a promissory note. To understand in the most easiest way what a bond is and how it actually works, there is a small chart which I have prepared for you. When a person goes to a bank, and in this case, you can take your own example. When you go to a bank and seek a loan, bank presents you with a loan, but they charge you something called interest. So you take a loan and you pay interest to the bank. You use that money which is being provided to you, which is being loaned to you by the bank. You use that money for a specific period of time, and then you have to repay that money. Until the time you're using that money, you pay something called interest. Bond works exactly like this, but instead of you being the borrower, you become the lender. So any company, any big company or a government of a country wants money to operate. So what they do, they need this capital, they need a loan, and they invite investors and they tell them that, okay, we need money and we are seeking a loan from people. And because we are seeking a loan, I want all of you to lend us money, and we will use this money as a government. Until the time we are using this money, we will pay you something called interest. Now, this interest is in the terminology, it's called a coupon. We'll individually visit each and every terminology which it is. but we are going to visit this and we are going to understand how a coupon actually works. But to make it very simple, bond refers to a debt instrument. So it's just like a loan, and this loan basically is given to governments, it's given to corporations, given to companies by you as an investor. Now how that's going to work out? So for example, uh, the US government wants money to invest in infrastructure, to build roads, bridges, dams, anything. So what they do, they issue a certificate called bond, which says that this particular investor, for example, I'm going to put your name into it. Say, for example, Yogesh, I'm going to put my name into this. Let's say Yogesh wants to lend money, and Yogesh is lending us $100,000. We are going to issue a certificate to Yogesh which says that Yogesh has lent us $100,000, on which we will pay him a yearly interest of 5%. And after 5 years, in 2028, we will return Yogesh's money. And till the time we are using his money, we are going to pay him interest. So if you see this diagram, the investors is you, and you are providing the capital or the loan to the government. Now, this could be a government or it could be a big company who is seeking loan. So you provide them the loan, and in return, the government or the company, which is basically borrowing money from you, gives you something called a coupon or a interest payment, right? So it works exactly like a bank, but this time you're the bank. And because bond also means a promise, so these government or companies, whosoever requires this loan, issues something called a bond certificate. They issue a certificate which looks exactly like this. I mean, this is the animated form of what you see, but this is exactly what it looks like. And when you click on this, sorry, when you look at this, a bond certificate, it shows the name of the bond holder, which is in this case is Yogesh, who has lent money. The bond issuer, which is US government, the amount of interest which I am going to receive, which is called coupon, that is mentioned in the bond certificate. So this is really important, guys, to understand what bond actually is, because now when we are understanding, let's highlight what we have seen. What is the main features of this product? So first thing is the issue size and the face value. So we should understand a few very important things about bonds. So and sometimes the terminologies really matter, because and these are the most easiest things we have to understand, because this is the language at which a lot of times you will be able to read articles which will talk about the bond issue. So when we say the issue size, it's basically how much money the government or the company is asking for as a loan, right? So if US government needs $500,000 or $2 million or $10 million, so together they will put that offer in the market that we need $10 million worth of loan, and we are inviting people to loan us money so that we can pay them interest, and eventually we will repay their money after a certain period of time. So just to give you an example, if a government is issuing around 2 million bonds with a face value of $100, that means the issue size is $200 million. And this issue size basically reflects how much money the government or that entity wants to borrow, right? So it shows the market's demand for the bond. And that is what a issue size is. So please continue to write. If you have any questions, please continue to write it on the chat option. If you don't understand this, I will be able to explain it to you again and again. And of course, if you miss out on this recording, a recording of this session will be put on YouTube, so you can always revisit what we have discussed. The advantage is that while we are doing sessions live, you can ask your questions and we can understand this together, right? So when I say the issue size and the face value, which means that how many number of bonds are issued at what price. So if a government or a company needs to borrow $200 million, so they can issue, as I said, very easily at a face value of $100, they can issue something around 200 million. So this is something which, if they issue 2 million bonds with a face value of $100, which means they need a money, or they want to borrow money around $200 million. This is called issue size. As an investor, what you will do, you can buy 10 bonds, you can buy 20 bonds, you can buy 100 bonds at the value of $100, which means you will be able to lend $10,000 to the bond issuer. Who is the bond issuer? So if, just to understand, everybody is on track. If US government is seeking a loan from the public, who will become the bond holder and who will become the bond issuer? So first tell me, use your chat options to tell me who will be the bond issuer in this case. Me as a client, me as an investor, or US government who is seeking a loan? Who becomes the bond issuer? I'll put this chart for you. So the idea is that we always have to make sure that we continue to learn. The idea of this session is that everybody should be able to understand the concept. Again, we are available for a one-on-one session, but since we are talking about something very basic to begin with, so that we can move on to good strategies, right? So tell me, use the chat options, guys. If US government is seeking a loan, then what they will be called? Bond issuers or bond holders? So government wants to build bridges, they want to build infrastructure, they want to build hospitals for which they need money, and they want to borrow this money from people. So I want to know that who is the bond issuer in this case? Okay, perfect. Okay. Right now, people have started replying. Great. Exactly. So a lot of you have already replied. US government becomes the bond issuer. Why? Because they are the ones who are issuing bond certificates. They are calling everyone and telling them that take this bond certificate and lend us money. So they becomes the bond issuer. And anybody who lends money to the US government becomes the bond holder, because they are the holder of the certificate, which says what? Which says that we as US government are going to pay this gentleman their money back by the end of 5, 10, or 20 years, whatever is the maturity date. And till the time we are using their money, we are going to pay them an interest, which is called coupon. So that these are the main features of a bond, and it replicates exactly to a loan. When you borrow money from the bank, you pay an interest, and the money has to be repaid over a specific time period. Similarly, when you are buying a bond from a government, that means you're giving a loan to a government, and government will pay you interest for the time they are using this money, and by the end of the maturity of the bond, they will repay you the money back. So give me an answer, if you can, at this moment. uh, does this sound high risk or low risk to you? Giving a loan to US government and getting a fixed income out of this, and eventually getting your capital back at the maturity date. Does it sound high risk or low risk? Pick one. You can write your answer to the chat options. Okay, okay, right, okay. Perfect. So I think everybody is in sync here. So a lot of you have answered lower risk, relatively low risk. Absolutely. So this is exactly what we are talking about, because The investment is very simple. You loan money to a issuer, and you get an interest over it, and eventually your money gets repaid after a specific maturity date. Now, in this case, it would affect your investment if the issuer, instead of US government, was a private company, right? So tell me, instead of US government, if it is Apple or Amazon, or if it is Facebook, which basically wants a loan, which is more riskier, loaning money to US government or giving a loan to these private companies? What do you think? Use your chat options to answer, guys. Which is more riskier, giving a loan to a US government or giving a loan to Apple or Facebook or any corporate company? Right? Okay. 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 Perfect. Perfect. Okay, great. Just love how everybody's answering. Great. Great. Perfect. 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 Yeah, somebody just said based on the rating. Absolutely, based on the rating. So we just assume sometimes. So yeah, I mean, a US government at this point will be less riskier. Uh, and but instead of US government, if it was some other government like Maldives, for example, or a Venezuelan government, then giving a loan to Apple or Facebook will be much better than those. So, absolutely. Depends on the credit history, depends on the credit dependability of that particular issuer. So, what we have understood is that you can loan money to a government, you can loan money to a company, and you will receive interest in return of that. Obviously, because when you are giving a loan to a company, your risk is slightly higher, so you get a higher coupon, you get a higher interest in that case. In case of government, because your risk is less, so your interest is also lower. So it depends on you as an investor, that what's your risk appetite. Are you a slightly balanced investor, so you would go with corporate bonds if you're seeking a higher income? But if you want to be on the conservative side, income does not matter to you as long as your capital seems to be preserved, you would look to US government or treasury bonds, as they call it, right? So now, once you have understood the features of the bonds, let's understand how many kinds of bonds are there, because this is something really important. And you would know that as an investor, you can diversify into all these kind of different bonds. So we want to make sure that this is something which is easily understandable to everyone. And bonds can be of very different types. So for example, when we are looking at fixed rate bonds, now fixed rate bonds, for example, so as the name suggests, these are the bonds whose interest rate which you receive, it remains constant throughout the life of the bond. What do you mean when I say what do I mean when I say throughout the life of the bond? Which means, if you have purchased a bond, and which means when you have purchased a bond means when you have lent money to the issuer of the bond, and the bond will mature in 10 years. What do I mean when I say the bond will mature in 10 years? It means that after 10 years, the issuer will repay me the money which I have lent. So when the bond matures in 10 years, throughout those 10 years, I will get a fixed interest rate. Interest rate in market can be any, it can increase, it can decrease, but I will be getting that fixed rate. So this is called a fixed rate bond. Then it comes floating rate. What is the floating rate? Where the interest rate basically continues to change as per the benchmark, right? So a lot of times we will see slight volatility in the interest rate. So for example, on a periodical basis, a US government bond interest rate might change. So under a floating rate, the reference to the coupon which you receive, or reference to the interest which you receive, it depends on what is going on in the interbank rate. So there is a floating rate bond also. Then comes a corporate bond. As the name suggests, so there is a government bond which is basically us lending money to the government, and then there is something called a corporate bond. Corporate bond means we are giving a loan to a company. So it could be Apple who is seeking a loan to invest somewhere or to expand their operations somewhere else. So they would require some funds, and that's why they would issue bonds. So when we are talking about corporate bonds, these are basically issued by the companies, and these bonds are sold to various investors. And the most important part is, again, uh, as somebody just pointed out, it depends a lot on the credit rating agencies, that which bond could be better, because maybe a bond issued by Apple is much better than the bond which is issued by Walmart, right? So the comparison obviously depends on how strong and how cash rich a company is. And as I said, government bonds, we are all aware about how a government bond will work. So every government has a bond. Most of the governments, I must say, they have bonds. And that's their way of raising money so that they can use that money and do economical activities. So US government bonds are called treasuries. Always remember this, write it down if you wish to, on a piece of paper. So the US government bonds are called treasuries, UK government bonds called gilt, um, we the French bonds are called oats, and German bonds are called bunds. And like this, there are a lot of countries which issue bonds. And again, I keep saying this again and again because I'm sure a lot of you must be already knowing about this. But those who are fairly new to these terminologies, when I say bond issuers or every government issue bonds, by issuing bonds means government is seeking loan from the common people. And when we say that we are holding bonds or we are bond holders, that means we have lent money to that particular entity or government who is the bond issuer, right? So again, there are government bonds, then followed by there is something called corporate bonds. As I said, there is something called a zero coupon bond. Now, what is a zero coupon bond? So coupon means the interest, zero coupon means no interest. Why would you give a loan if you're not receiving any periodic interest? So the catch is that they are issued at a discount and redeemed at par. What does it mean? It means that when you have to loan to the government, and when you are buying these bonds, you are buying these bonds at a face value. So for example, if the face value of a bond is $100 and you bought 100 bonds of $100 each from the government, which means you have given them a loan of $10,000, right? But sometimes in case of zero coupon bonds, what happens, you do not get periodic interest payments. You buy these bonds, instead of 100 you buy these bonds at $90. So you are buying it at 90, but during the maturity you receive 100. So that $10 extra is your gain, and that $10 includes the interest also. So that's why zero coupon bonds, the good part about zero coupon bonds is that there is no reinvestment risk in it. But then there's a disadvantage also, that if the duration of the zero coupon bond is too large, 20 years or 30 years, then your capital is blocked for a longer period of time and you're not receiving any periodic payments. So again, it depends on the risk appetite of the investor, that how much yield or how much interest rate they are actually seeking. Then there is something called high yield bonds. The yield, we are going to talk about what the yield actually is. So yield is the total return on the bond, or what is expected from a bond. What is the interest rate which is expected by the investors for this particular bond? High yield bonds are mostly junk bonds. And when I say junk, which means you can call it garbage bonds. But instead of using the word garbage, why we use junk bonds? Because these are issued by the issuers who may be more riskier than the other issuers. So if you are, for example, if a friend of yours has a very bad credit history, doesn't have a job, and he's asking you for a loan, you will give him a loan, but you know that the chances of that money coming back is slightly less. So you will charge a slightly higher rate of interest, right? Because you are taking a higher risk. So higher risk bonds they expect higher yield or a higher return. So there are such bonds which are called high yield bonds. And if the investor has an aggressive risk appetite, you can actually invest in these high yielding bonds, right? We're going to take examples of a few of these strategies. Then there are also something called convertible bonds. Convertible bonds, as the name suggests, uh, this basically allows the holders to exchange these bonds and convert it into equity shares. So it is possible that Apple issued some bonds, but with the option that after 3 years, these bonds will be converted into shares and you can actually participate in the ownership of the company. So these are called convertible bonds. It basically gives the investors an option to convert their bonds into stocks. Inflation indexed bonds, something which is really important given how high the inflation was 1 year ago. It was almost 40 years high. So the inflation indexed bonds are basically the coupon which you receive, the interest which you receive. It is tagged with the inflation rate. So basically, they try to protect the investors from the inflation which is prevailing in the economy. What if the inflation reaches to X amount? The coupon on the bond also will reach to the exact amount, basically to protect the value of your investment. So those are called inflation indexed. So basically, they are the coupon payments or the interest payments are linked with inflation, right? And then there are subordinated bonds, foreign bonds, or municipal bonds. Subordinated bonds are basically unsecured debts. And again, this is something, if I were to say, the credit rating of these bonds are not very high. These are basically unsecured debts, and these are issued by banks. There are foreign bonds. Again, foreign bonds means these are issued by a foreign company in the domestic market. So there are a lot of foreign bonds as well. And also something called municipal bonds. So municipal bonds is basically agency. It's a government agency bonds only. So there is US government which are issuing their government bonds, which is treasury bonds, which is directly issued by the US government. And then there are municipal bonds which are issued by the municipal authorities in US. So these are mostly government agencies which are issuing the bonds. They're also very strong, because how do we know that a bond is stronger? Is basically who is the issuer, right? A US government bond will be less riskier as compared to a Venezuelan bond, right? Something which is much more safer. It will determine the safety of the issuer also. Now, what is a bond yield and how normally we see the yield curve? Why I'm explaining you this, guys, because I am going to do a touch base on how bonds have become an interesting choice of option. And for that, we need to understand how a bond yield and how a curve actually works. So we understood that few things which are really important is the maturity of the bond. And what is the maturity of the bond? Maturity of the bond means when you as an investor are going to get your money back, which you have lent it to the issuer. Who is the issuer? Issuer can be a corporate, issuer can be a government, right? Now, what is a bond yield? So, bond yield is a measure of interest. You can see, please check the slide as well. And if you want, you can note it down. So, bond yield is a measure of interest that takes into account the bond's fluctuating changes in value. And there are different ways to measure bond yield, but the simplest is the coupon of the bond divided by the current price. So whatever is the current price of the bond, if you purchase it for $100 and you are getting 5% coupon, which means on you are getting around $5 coupon on $100 bond, which is 5 divided by 100, 5%. So the bond yield is 5%. Correct. Now the chart which you see, it shows the yield from lower to higher and the maturity, 1 years, 2 years, 5 years. This maturity which you see, a horizontal curve, this is in maturity in years. So 1 year, 2 years, 5 years, 7 years, 10 years, 20 years, 30 years. As you can see that the yield curve is like this, right? So if you were to see this chart, can I say that the expected return on a bond which matures at 30 years, it's higher, and the bond which matures in 1 year, the yield is lower, right? Can you see this? If you see it right here, the 1 year bond has a lower yield as compared to a 30-year bond which has a higher yield. Why? Can anybody tell me why a 30-year bond is expected to give a higher return, or the yield expectation, the return expectation is higher from a 30-year bond? Can anybody tell me why? Right? Okay. 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 I think most of you are exactly on point what you're going with, and I think it's working well. So a lot of you are actually giving me the right answer. Yeah. So if I were to see this, a lot of you have pointed out. Yeah. Perfect. 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 Great. So a lot of you said the same thing, that 30 years bond, because the duration is high, the lock-in in the money which is kept there for 30 years, the risk is higher, right? Also, let me tell you, when you buy a 30-year bond, which means the bond which is going to mature in 30 years and you're going to get your money back, it's not a lock-in period. Okay, if you buy a 30-year bond, because somebody just asked a question that if I'm buying a 30-year bond, does that mean that I cannot get out of that investment for 30 years? No, it's not like that. So if you're buying a 30-year bond, you can sell the bond anytime during that duration. It's just that if you have bought a bond which is 30 years and you sell it in 2 years, so you will not receive the rest of the coupon for the rest of the 28 years. So you can always sell your bond at a higher price depending on the market forces, and you can get out of it. So yeah, but if you want to hold on to the bond for its entire maturity, that will be 30 years, right? So you will get coupon for 30 years year on year. So that's what a bond yield curve is. So bond yield curve is slightly on the right side, increasing a upward sloping curve. If I were to say it, it's a upward sloping curve. Upward sloping curve simply means that shorter term bonds, they are expected to have lower yields, and higher term bonds are expected to have higher yields. That's why it's a upward sloping. Sometimes this slope gets inverted, which means when people are under panic, they start expecting higher yields from short term bonds also. And that happens when the investors are under panic and they don't trust the issuer. So during recessionary conditions, we have seen that the bond yield curve, it gets inverted, and that happens, right? Now moving on, so few points to understand. The bonds can be issued, just to reiterate what we have discussed, bonds can be issued by companies, can be issued by governments, and they pay you a interest, right? Market value of a bond, it changes over time as it becomes more or less attractive to the buyer. So if you have bought a bond at $100, and if the bond becomes more attractive to the investors and they start demanding more, the bond prices can go higher, right? Bonds that are high quality, they are which means most likely to be paid on time, they generally offer lower interest rates, something which we just discussed, that if the credit worthiness of the issuer is good, then there's a possibility that the yield will be less because your risk is less. Bonds that have shorter maturities, they tend to offer lower interest rate, is what we just saw in a yield curve, that shorter duration bonds, they offer you lower interest because your money is kept for a less period of time. So it's all risk and reward, right? Next, coming back to bond strategy. So this is the final session, guys. Since we have understood what bonds are, we have realized how bonds actually work, what are the key features. So once again, before we move on to the strategies, I would like to bring your attention to the fact bond is a debt instrument, right? When you buy what is the main difference between a stock and a bond? When you are buying a stock of Apple, you become a part owner of the company. You become a business partner when you buy a Apple stock. If you buy a Apple bond, if you buy a bond which is issued by Apple, then you become the lender. You're not the business partner, you are the lender, which means Apple promises to pay you your money back. In case of a Apple stock, Apple does not promise you to pay your money back. You have the risk that if the Apple goes bankrupt, then there is a possibility that your capital could go zero, right? And when you're buying a Apple bond, Apple pays you a fixed interest rate. If you're buying an Apple stock, Apple does not pay you a fixed interest rate. So it is as good as a difference between being a business partner and being a lender. When you are buying a bond, you are a lender. When you are buying a stock, you're a business partner, right? So that's the main difference between a stock and a bond. Clients, investors, they invest into stocks, they invest into bonds. So if you are having a slightly higher risk appetite, you will invest into stocks, but at the same time, to balance your risk appetite, you can allocate some of your money to bonds as well. So at the end of the day, it's all about diversifying your investments into different asset classes. You buy Apple stocks, you might get a higher return, right? Because the stock price can jump really high. If you're buying Apple bond, then all you earn is the fixed interest, right? So it depends on how you want to tweak your income idea and what is your risk appetite. Of course, here at Century, you can speak with your consultants and they will tell you that what can be done and how you can invest into Apple bonds and stocks as well, and how you can balance your portfolio out. Now, coming back to the strategy. Now, this is again, guys, something really important because we have to understand what has happened in last 2 to 3 years, because we have seen a very high inflationary market. All right. And a high inflationary market means that we are talking about the economy where inflation reached 40 years high, and it wasn't normal. And this anyways happened, and the central bank had to take extreme measures to cut down this inflation. So just to give you an idea, let me just open and share a flyer with you. Okay, right here. Please let me know if you can see the flyer which I'm sharing with everyone. Right now, the slides are open. I'm just trying to share it. And we're going to look at the trajectory of what is expected in the future. So just one second, share screen right here. Okay. So guys, I've shared a flyer with you, and this is we are talking about the treasury bonds over here. Okay. And this is one idea. We are going to do analysis of the price trends and the scenarios, what is expected out of the bonds. Before we get into it, let me tell you what has happened in last few years. So in second, I'm just going to switch off my cam because it is impacting the network. Please let me know if it gets better. Okay, if you can hear me clearly, please write a yes or a okay because it shows my network could be lagging. So I've switched off my cam. If you can still hear me properly, just give me a thumbs up or a yes so I'll just get to know. Okay, okay. I think most of you can hear me. Perfect, perfect, great. So I'm anyways going to keep the camera switched off so that the network doesn't lag. So what happened in 2020? Because of the pandemic, a lot of cash was being injected. A lot of cash was being injected in 2020 because of the lockdown which happened, and because of that heavy injection of cash, we saw a massive inflation increasing, because in 2020 this was done to ensure that people have enough money in their pockets and they're not impacted by the lockdown. So the US government kept printing more currencies. Also, what they actually did, uh, there is something called cost of borrowing, or what we call it as interest rates. Okay, so central bank of US, they lend money to the commercial banks at a certain interest, and then commercial banks loan that money to the consumers. So today when you borrow money from ADCB or Emirates NBD or any other bank, these are basically commercial banks, right? So they charge you an interest rate, but who decides that interest rate? That interest rate is decided by the central bank, right? Now, tell me, if the if you have to loan, if you have to take a loan, the most important part you will see is the interest rate, right? If interest rate is higher, definitely you are going to ensure that your borrowings are less, because everybody loves cheaper credit. You would love if you could borrow money and use that money in your business or buy stuff with it, and you pay less interest rate, right? So in 2020, to ensure that the people are not uh, bothered by the lockdown, US government injected more currency, more, they printed more currency in the system. Also, what they did was cut down the cost of borrowing, which means investors could borrow money at a cheaper rate. And it was not just US, Europe did it, India did it, UK did it, Japan did it. Most of the economies around the world, they cut down the cost of loans so that the investors could borrow money at a cheaper price. And also, a lot of economies, they printed more currency to ensure that the investors have enough. And that was the reason. So when lockdown was removed and 2021 came in, vaccines came in, people started getting out of the house, business started getting revamped, everybody had enough money to start demanding more and more, because loans were cheaper, more currency was being printed, and now the lockdown was removed. So more, a double demand for travel, for consumption, and that such a high demand increased the price of everything. And that's how the inflation started increasing. Also, at the same time, around 2021, 2022, Russia Ukraine war started. When Russia Ukraine war started, there was an energy crisis, oil prices shot up, gold prices went up, and a lot of food commodities which were exported by Russia and Ukraine, the supply got disrupted, so the prices of all those food commodities also went up. And then there was already so much inflation which was going on, so the inflation increased. Now inflation is neither good nor bad. You need people to have money in their pockets so that they can demand, but also you do not want people to have too much money also, so that they can keep demanding higher and the supply is not met, because that pushes prices higher and makes people who are living below the poverty line, it makes difficult for them to buy anything. And that starts a ripple effect on the financial system. So that's why the inflation needs to be controlled by the central bank. And to control that, they keep increasing or decreasing the interest rate at which you borrow money, right? Why this is important? Because bonds are all about interest rates. Bonds means you lending money to the US government and earning an interest over it. So before 2020, the interest rates were actually down. So nobody would be interested to loan money to anyone or US government, because they will earn a very lower rate of interest. They can make more money in the stocks, right? But after 2020, because inflation was so high, the central bank of US increased interest rates from 1 or 2% to 5.5%. So right now, if you loan money to US government, you will earn 5% a year. And that's why the bond has become an important choice of investment for a lot of investors of lately. Right now, I am going to discuss this flyer with you. And when we are reading this, we'll try to go through each page one by one to understand what has been going on. So let's understand what this flyer is about. The US Treasury Bond Ultra. What does this mean? This means the US Treasury Bond is nothing else. It's basically a US government bond, okay, of a higher maturity, 30 years maturity. So a US Treasury Bond Ultra. Please remember this. I'm repeating this again. A US Treasury Bond Ultra or a T Bond Ultra is nothing else but a 30-year US bond. A bond of US which will mature in 30 years. Anyone has any doubts in what I just said? Do you want me to explain this again to you? What is a Treasury Bond Ultra? Can anybody tell me what is a US Treasury Bond Ultra in the simplest way? Use your chat options. Anyone? Just use your chat options to tell me what is a US Treasury Bond Ultra. I just told you. A US Treasury Bond Ultra is nothing else but a 30-year duration bond. So a bond which is, and this is a terminology, and this is something which you can easily find on Google as well. It's not that difficult. A Treasury Bond Ultra is a 30-year bond issued by US. A treasury bill is a bond which has a maturity of within 1 year, less than 1 year. So it's a very short term duration bond. A US treasury bond, which is not ultra, has a maturity of 5 to 10 years. So, based on the maturity years, the US government bonds are classified. Treasury bond ultra is the highest maturity, 30 years. Treasury bill, lowest maturity within 1 year. And in between, a medium term maturity of 8 to 10 years or 5 to 10 years is called US Treasury note. Correct? Anybody has any doubts, please ask the questions right away. And I hope everybody can hear me right, because it keeps showing me that the network is unstable. I hope everybody can hear me right. Okay. So now coming back to the flyer, the US Treasury bond is priced, a Treasury bond ultra is priced at $112 as on 25th October, right? As it when this was made. So the price of the bond is $112. Based on the analysis, if the 30-year government bond yield increases by 75 basis points, the price of the ultra is forecasted to decline to 96.8. And if the US government bond yield decreases by 75 basis points, the ultra price is expected to rise to 129. Right now, what does this actually means? Government bond yield increases by 75 basis points, or the government bond yield decreases by 75 basis points. Yield basically means we are talking about the interest rates, right? We are talking about the interest rates. If interest rates in US, the cost of borrowing in US, if it increases by 75 basis points, the price of this bond is expected to come down. But if the interest rates starts coming down, in US, then the price of this bond can go higher. Now, before we proceed, guys, one thing which we have to establish: the relationship between the bond price and the interest rate, which means, tell me this and solve this for me. Let's say you have a bond which is paying you 2% interest. Okay, write this down on a piece of paper. It will help you to really get this scenario. Let's say you gave a loan to US government and bought a bond on which the US government is paying you 2% interest. Okay, now because it's a bond, so it promises you to pay you interest of 2%. So you will receive 2% for the next 5 years because that's when the bond matures. Now, something happened and the central bank increased the interest rates from 2% to 3%, which means that you have given your loan to the US government, you are receiving 2% interest. But now the current market central bank has increased the rate to 3%, which means if your friend was to enter now in this market and loaned money to US government, he will receive 3%, right? So what you are thinking? You are thinking that why I'm holding this 2% bond? I should sell it and get a 3% bond, right? But who's going to buy your 2% bond unless you sell it on a discount? So, what happens when interest rates are increased? The price of the bond normally decreases because people start selling the lower interest rate bonds at a discount. And that is the reason why the price of the bond and the interest rates, the cost of loan or the borrowing rate, are inverse. So what we have seen in last 1.5 years, the central bank has increased interest rates to curb down the inflation, and due to this rapid increase of interest rates, the bond prices came down a lot. And that is the reason why, because it came down a lot, people started buying a lot of bonds, because next year it is expected that the interest rates are going to be kept stable, or it might be cut down, because the inflation is almost under control. It was 9% and now it's 3%. You can check inflation by looking at the consumer price index data. And that is the reason this is expected, that in case if the interest rate starts coming down, the bond prices will start going higher. Why will that be the case? Because everyone who's receiving 5% interest right now, if the interest rates go down, their bond will become a premium bond, right? Anybody who wants to then buy a 5% bond will have to pay a little extra, because in the market the interest rates have come down. So that's why the bond price and the interest rates have an inverse relationship. Now, coming back to the flyer, what you just read, that if the government increases if the central bank increases the rates by 75 basis points, we will see the price of the bond coming down. But at the same time, if the central bank decreases the interest rates, the price of the bond is expected to go higher. Currently it is at 112, might go to 130 also. So for $1 million portfolio, with a 2 times leverage, we created a scenario where how much return you can earn. So 2 times leverage 13%, no leverage 15%. And to give you an idea, the contract size of a bond is $100,000. In this case, a 30-year treasury bond, and it's giving a 6% interest, right? So US Treasury Bond Ultra, it's a contract that tracks the price movement of the 25-year and the 30-year bonds, right? Here, what is the expectation in the future? So in early 2022, and this is the most important part, guys, you can see this one and you can take a picture. And again, some of you just asked that, can we have a one-on-one session on understanding bonds? Absolutely. And for this, you don't actually have to pay anything, or you have to sign up for anything. just talk to your RMs who have connected you to this webinar, and we'll do free of cost a live session for you one on one. You can come to our office in Emar Square, and we can definitely do a one on one session on bonds where we can explain this to you in a again much elaborate way. We have a time constant already, but definitely we are going to discuss more and more strategies with you if we are sitting one on one. So the most important part right here. So the what is the path ahead for central bank? What are we expecting from the central bank at the moment? So in early 2022, the Federal Reserve, which is central bank of US, it embarked on a mission to control the inflation, right? And how they controlled the inflation? By increasing the interest rates. Now they avoided an economic downturn, because when loans become expensive, it affects the companies, because companies, they only work with cheaper loans. Now since then, central bank has hiked interest rates very aggressively, and the interest rate, the cost of loan now is 5.2 to 5.5%, and this is the highest in 22 years, right? Now, as per the latest economic reports, the US economy has shown still a lot of strength, but obviously it seems that the interest rates which increased in last 2 years, now it seems that they have peaked out. Peaked out means now central bank is not thinking about increasing rates anymore. So recently we have seen the bond yields have also started going higher. Yields means the total return or the expected return on the bond has started going higher. The 10-year yield surpassed 5% for the first time since 2007. So this is again when the bond yield starts getting higher, which means when the investors, they start seeking higher returns, or they start expecting higher returns from bonds, which means it basically this is the investors' confidence which is a bit shaken up. So normally the government would not increase, the central bank would not increase more rates. Now when that happens next year, that could increase the price of bonds, because if they're not increasing rates anymore, which means if they're not increasing it next year or mid-year, they might reduce the interest rates. Reducing interest rate will increase the price of the bond, and that is the reason that why a lot of investors are currently stocking up the US government bonds, right? Now, going further, these are the interest rate probabilities of US government, and we are taking example of US government because it is considered one of the safest bonds in the financial markets. Now if you see the expected Fed funds rate or the interest rate, it is around 5.5%, and they're likely to hold this interest rate until mid 2024. So if you buy a bond now, you are still seeking a 5.5% interest on it, right? Now, just to show you a historical analysis, um, this was since 2010, which is basically the base case over here, the foundation of the study. It demonstrates the movement in the bond prices when yields decline. So when 30 years bond yields declined from 4.5 to 4%, the bond prices went up by 8%, right? And when bond yields further declined by 3.5%, it went up another 7.5%. So this is something which is really important, guys. Historically, we have seen that whenever the yields of the bonds, they reduce, the prices of the bonds, they go higher, twice the decline of the yield. So this is where we have to understand, guys. Again, the flyer, you can always come and sit and discuss with us. I understand bonds is not something which a lot of you must have seen. A lot of people, they trade in commodities, they invest in stocks and indices. But 10 years ago, nobody cared about bonds because it was not that promising. But now, imagine you are just giving a loan to US government and earning a 5.5% interest. There's a question here. With Fitch and Moody's reducing US credit rating, how do you see it impacting a US bond market? So this is actually really important, right? Because US bonds were seen to be considered the most, I wouldn't say risk-free, but relatively less riskier, right? So that is something which is really important. And there are credit rating agencies which rate these bonds, and US bonds have always mostly been rated as AAA and AA and good bonds. Basically, the credit worthiness have always been a very important factor. But the question which was asked recently, somebody just asked the question right now, that with Fitch and Moody, the rating agencies, they have reduced the US credit rating. So how it will impact the bond market? And this is something which is, guys, really, really important to understand. And why? Because the credit rating of the bond is what makes the bond a good buy or no, right? And of lately, the rating agency, which was Moody, they lowered their assessment of the US credit. And this is really important. Why? Because at the end of the day, we will see investors whether they are interested in buying these bonds or not. What are the clients doing? I'll tell you, sir, who have asked this question. Currently, because the bond prices have dropped a lot, investors are just stocking up the bonds at a lower prices, right? Uh, the important part is that while Fitch and Moody's they have reduced the US credit rating, I would suggest you to invest into medium term bonds, something which is either 2 to 3 years, right, or something called as treasury bills. This is something really important. So what are treasury bills? Treasury bills are basically bonds of US government which mature within 1 year. So your observation is right. Moody's and Fitch they did reduce the US credit rating, and that was going on when there was a government shutdown. But that was another reason that why the long-term bonds, the 30-year bonds, basically, uh, when investors are investing in, their risk appetite is slightly higher. If your risk appetite is not that high, you could just invest your money into a medium term 2 to 3 year bond, which should be relatively safer. Another important thing is whenever there are high interest rate changes, the longer duration bonds are more sensitive than the shorter duration. See, bond is a fixed income instrument. You need a fixed income instrument in your portfolio, right? You cannot just have stocks or commodities. And when it comes to fixed interest rate instruments, if not US government, which else, right? You have to ask yourself also this question, because of course there are a lot of Indian bonds which are there. There are a lot of other economies also, but then US government, in terms of liquidity and in terms of markets, it's pretty high. So the reducing of the credit rating has impacted, but not fully. A lot of investors are still flocking up on a medium term to shorter duration bonds. And currently, rather than keeping your money in the bank in fixed deposits, it's always better to buy treasury bills, which are basically up to 1 year of maturity, and they give you a fixed interest. So I think bond market currently is still a very much favorite, because the expectation from central bank for the next year is to keep interest rates stable or cut it down. In either of the cases, the bond prices are expected to go higher. So that is the reason that why I still feel a medium term bond could be a good investment, just to diversify your portfolio, right? But this is just one strategy. I'm going to share real quick a second strategy also. Just stick with me for this. I'll just show you one more strategy. This is something which we were checking around. Just give me 1 second. I'm just searching this in my system, and this was related to the bonds again. Just give me 1 second, and until then, continue to write if you have any other question. Yeah, right here. So I just got this one. And so this is something which is slightly unique than what we normally see, right? There are a lot of treasury bills and treasury bonds, but this is what I'm going to share with you is slightly different. And this was another reason that why, because good that you asked this question. So let me just share this with you real quick. So just have a look at this. I'm just showing you a chart over here, and this is a equity risk premium chart. To explain you in the most easiest way, equity risk premium is lowest in 20 years. What does this actually mean? Because you asked this question that, what is the outlook on bonds after the Fitch and Moody has reduced this credit rating. The equity risk premium means the extra premium which an investor gets when they switch from bonds to stocks. It's basically very simple. When you choose to invest into a stock as compared to a bond, you expect a higher return because you are taking a higher risk. Giving a loan to US government versus becoming a business partner of Apple, these are two very different scenarios, right? Apple could go bankrupt, it's a company. But US, if it goes bankrupt, it's going to be a massive failure, right? So the chances of that happening is slightly less. So obviously, when you buy a US government bond versus when you buy a Apple stock or any stock for that matter, the risk which you take is extra, so the return what you should get is also it should be extra, right? And that is called a equity risk premium. So the premium which you receive by taking an additional risk when you switch from bonds to stocks. Now this is seen, the chart which you see, it shows that this risk premium, which used to be much higher back in 2002, has actually reduced to a 20-year low. So right now, the investors do not feel really motivated to switch from bonds to stocks because the equity risk premium is almost same. You are basically earning a similar amount in stocks as you are earning in bonds. So stock market is not giving that kind of a return. So that's why this was something which we did a research and analysis and found out, and that's why I shared this with you. This kind of gives you a decent understanding of what is the expectation. The actual average investor expectation is that if I switch to stocks from bonds, I should get enough premium for taking that additional risk. But the problem is that risk premium is lowest in 20 years. It's barely anything. So instead of switching towards stocks, a lot of investors are still very comfortable investing mostly in bonds. But as I said, that as an investment consultant, I would always stress on diversification. So even if you have stocks investments, I would always suggest that have a medium term or a short term bond investment also, because the returns which you are getting currently on bonds are much better than what you used to get 10 years ago, right? So guys, these are a few things which I wanted to discuss about bonds. Again, strategies are endless. When it comes to bonds, there are a lot of pair trades, there are a lot of other strategies, there are a lot of corporate bond strategies also, and we can discuss all of that with you. And this is something which, as I said, if you want to come down to our office one on one, we'll definitely sit and discuss. And this is something which we do always for all our prospects, all our clients, anybody who's interested, because knowledge is something which is it's mostly an awareness what we are doing currently, and it has no price. Obviously, anybody who's interested in understanding about bonds more, our doors are always open. We are working throughout the week, and we are working throughout morning till evening. Anytime you want to come and drop by and understand how these things work, I will be available. Just give me a heads up, and I'll definitely be available to share strategies with you. And these webinars, some of you asked that how often we do these sessions. We do these webinar almost every week on different topics. So next week will be a different topic. It will be mostly trading strategies. After that, it will be investing in different sectors and investing in EVs, investing in AI and robotics. So we keep doing these kind of awareness sessions. You want to know more about these, please join us on in our office in Emar Square. We are Century Financial Consultancy. We are based in Building 4. We are based in Emar Square, and we would love to sit with you and have a one-on-one session about investments. If you have any other questions also about how to use a trading platform, how to see charts and technical patterns, we do expertise in that, and we can sit and teach you that as well. So once again, thank you so much for being in this session. This was a great 1 hour, and I hope that we all have learned a few things about bonds. And nonetheless, there is a lot to learn. There are a lot of strategies we can discuss. and I'll be more than happy to sit with you individually, one on one, and discuss the same. So once again, thank you. Have a good night. We'll see you next week, same time, similar day, but with a different topic. So until then, be safe, have a very healthy investing, and continue to do your risk management. Just a few questions over here. Somebody just asked about, can you share the slides to the email? Yes, we definitely can. I'll just check if this is something which we can do. We can definitely do it. Not a problem. Definitely, we can share the slides with you.